at an example here. The upper title shows Amortization Schedule 2013. We just read the first box here. If we not look at the amortization for a minute. First box, it tells you the problem here. December 31st, 2012, Smart Touch Company purchases land and building by paying cash and signing 30-year mortgage for $100,075. Just up to this point, can you tell me how to journalize this entry? Purchase entry. If we're purchasing items, assets, so what do we debit here? We will be debiting building, remember Chapter 9, and land. And what about credit? We're paying a part cash, a part of it by cash, usually down payment, and then the other part will be the new account in this chapter, mortgage payable. And it tells you the dollar amount, right? Cash we're paying part $49,000, about $49,000, and the other part about $100,000 we're paying by mortgage, meaning this is a liability. We're not paying immediately. This is the part that we're paying immediately. Okay, so whatever this dollar amount is, the left-hand side should equal the right-hand side. This is what the journal entry would look like. So this part will go into, remember in Chapter 9, group purchase, we talked about relative assets weight. At that time, lump sum purchase, this will be how we determine the left side. Okay, but in this chapter, we'll be focusing on how to deal with mortgage payable here. Okay, so this right-hand side here, mortgage payable, this is the part that we're trying to get to, how to account for this. How do we spread this along months, along years? How do we pay it off? That part, the liability. This entire table is dealing with this. Okay, now, it tells you that we agree on a monthly basis. Usually the problem will tell you what is the mortgage amount. It would also tell you on a monthly basis what is the fixed amount of payment. In this case, it's $600. Okay, this in reality is also set up front. So the portion of mortgage on a monthly basis that if you purchase a house, a home, or a different property, each and every month the payment for mortgage is the same. It's a fixed amount. Okay, so this dollar amount will be given to you in problems. Just take it as given. What we need to do is determine what part are we paying as principal amount, what part are we paying as interest amount. Okay, so the middle two column is the part that we're trying to determine here. Right-hand side, mortgage dollar amount will be given to you. Left-hand side column, $600 fixed amount, you will also know this information. Now we need to calculate what part is interest that you're paying, what part is principal. So we break down that $600 into $500.38 and $99. Okay, so we get to interest expense by using the green box over there. The full mortgage payment times the interest rate given to you, 6%, times just 1 month over 12. Okay, again, mortgage is paid on a monthly basis, so interest is only accumulated for 1 month. Okay, now the pink box over there, principal amount. Principal amount, you simply get it from after you get interest, subtract that from 600. That will give you principal amount that you're paying. Okay, first we start from mortgage balance, $100,075. Fixed amount is given to you on a monthly basis. We'll be paying $600. So to calculate interest expense accumulated on this mortgage balance for the first month, we use the full amount of mortgage payment, $100,075 times yearly interest rate times 1 month. Because up to now, we're just dealing with January 31st, 2013. Okay, so once you figure out the interest portion, remember fixed amount breaks down to interest portion and principal portion. Fixed amount in this case is $600. Interest portion, you got it from calculating it in the green box, $500.38. Then the remaining is principal amount, $62. Okay, so this is the first month. Now, after the first month, if we just stop right here, after the first month, if we want to transfer this into a journal entry type, because remember, first month, what we're doing here is calculating amounts that we're paying $600. what part belongs to principal, what part belongs to interest. If we want to journalize this, credit side would be cash because we're paying off $600. This part we definitely know for sure. Every single month is always $600. The part that belongs to interest expense would be $500.38. And the part that we're paying as mortgage payable would be $99.62. Together forms this $600 of fixed payment. Okay, so principal amount we're paying, we just get this from after calculating interest, subtract it from fixed amount. And then it goes into this journal entry. This is the first month of payment. Credit cash 600. These two parts breaks down the 600 into interest payment, principal payment. Principal is referring to the original mortgage amount. Okay, so if we're paying off about $100 of original mortgage amount, after the first month, your original mortgage amount will be reduced to about $99,975. And then that will be the new base to calculate the second month's interest expense. Again, the green box, but now keep in mind the first number has changed because we paid off a little bit of mortgage payable. This is the part that we paid off. So you reduce it for the following month. So that reduced part will give you $499.88. So how do we get the principal payment for second month? The payment minus interest, 600 minus $499.88 will give you the second month's pink box. Exactly. Okay, so second month's dollar amount will not be this anymore. Even though the cash part is still credit $600, this is the part that will remain the same always for each and every month. Interest expense, account name is the same, mortgage payable is the same, but the dollar amount is different. So for the second month, it will be $499.38, and then principal amount will be $112. This will be the second month's journal entry. Okay, so after this, again, $600 breaks down to principal and interest. So the principal part, we're paying off an additional $100, mortgage balance reduced to $99,875. The part that you borrowed is gradually reducing as you pay off a little bit of principal every single month. So then the following year will follow the same structure. Following year, you will reduce it, the calculated interest expense, by another green box that has a different amount. So you will be replacing the $99,975 with $99,875. Okay, so that goes on and on. But just keep in mind, cash part is always $600. The cash payment that you're paying is always credit $600. The part that we're doing with this table is to determine which part belongs to interest, which part belongs to principal payment. Now the blue box showed here, amount to be reclassified to a current liability. Keep in mind that this entire table is just for 1 year. Okay, 1 year breaks down to 12 months. So your first month of payment looks like this, second month of payment, so on and so forth. When it reaches the last month, altogether this is the total mortgage payable that you paid off in an entire year. And this table we usually calculate it up front when we start the mortgage payable contract. We calculate this amortization schedule up front. This reclassification entry happens as soon as we sign off the mortgage payable. Okay, that entire table is there to help you understand on a monthly basis, how do we pay the mortgage, what part is interest, what part is principal. But don't forget that the entire year's payment, in the first entry, we immediately reclassify the part to current portion on mortgage payable as soon as purchase, building, and land entry happens. Okay, so just like long-term notes payable, we sign off long-term notes, borrow the money, reclassify it. For mortgage, we sign off, create this journal entry, and immediately reclassify the part that will be due in an entire year into current portion. Okay, and again, this dollar amount, you can get it from this entire table here, principal amount.